Hi guys, my name is Jimmy. I'm the trading psychology coach with the Birb Nest. I thought let me give you guys a quick introduction because not everyone knows me since we had recently a big inflow of new people. Before we start, I want to quickly start with a few definitions and later it will make sense why I'm giving these definitions. But first, this is a series of video. This is the first part of probably going to do 3 more videos or 2 more videos. This one is specifically about selling strategy and mindset and psychology. Everything when it comes to execution, there is a phase where you need to have the right mindset. And I believe this is the crucial part. The next video will be about the technical strategy, how I gonna sell, what my profit taking plan is. And in the third video, we can do a video about how to set your stop losses, where to set them, how to set them, what kind of different tools, free tools, but also paid tools you can utilize for a improved stop loss strategy, because a stop loss is also part of a selling strategy. But first, we need to start with a mental framework. So see this as a masterclass. If I'm not mistaken, everyone who's listening has a brain. It's a physical organ, and it's the most complex one that's responsible for a lot of things. For your coordination of your body functions, receiving, processing, sensory input. So sensory input, it's, the information that comes through your 5 senses. And it's basically there to generate thoughts, emotions, and behavior, and your brain is non-stop active. So you cannot really stop your emotions. You cannot stop and control your thoughts. You can have a lot of management of your own behavior, and that's the key word, behavior. Trading is all about behavior. And then we have the mind part, and this is the subjective experience of your consciousness. It's about your thoughts, your feelings, and your perceptions. So as you can see, they are different, but very, very interconnected. Your mind, your subconscious mind, has a few functions. It's a storage of data. It's there to protect you, and it's your path of least, and it will always opt for the path of least resistance. And I'm saying this because it will make sense why we make a lot of mistakes. And I can illustrate this by going through 2 maybe known for some of you, or maybe unknown to some of you, cognitive reflection tests. And by the way, why people are going for the path of least resistance is also a way of protection. Energy is scarce. We people don't like thinking. It has nothing to do with your IQ. It's just people are by nature lazy. Lazy thinkers means we don't make very logical decisions. And this is where people screw up when it comes to trading. Probably we all know this. This comes from Daniel Kahneman. Very simple test. Many of you know this. Some of you maybe not. So let me quickly go through this. The bet and the ball, together they $1.10. The bet cost $1 more than the ball. How much does the ball cost? If your first response was 10 cents, congrats. This is your gut feeling. This is your gut thinking. This is, your intuition. It's $1.10. It's 10 cents. And this is also the wrong answer. The logical answer is 5 cents. Because if it would cost the ball 10 cents and the bet cost $1 more than a ball, then together it is $1.20. The correct answer is 5 cents, because if the bet cost $1 more than the ball and the ball costs 5 cents, the bet would cost $1.05. $1.05 plus 5 cents is $1.10. This is a well-known, probably 90% of you would know this, I think. This is another cognitive reflection test. Mother and her child They are 50 years old in total. The mother is 20 years older than her daughter. How old is the daughter? Again, I'm getting a lot of wrong gut answers. Again, this is why I'm saying the brain, the mind, always goes for the path of least resistance, like the gut feeling, the intuition thinking. Why? Because it just requires less energy. The brain consumes a lot of energy. This is just a optimization process internally. You don't like to think. I don't like to think. The right answer is here. How old is the daughter? She's 15 years old. 15 plus 35 is 50. Now we know this, we also realize that there are a lot of emotions when it comes to trading, investing. It doesn't matter if it is the 1 minute chart or the 2-hour candle or the 3-hour candle, the weekly candle, the monthly candle, or anything in between. There's a lot of emotions. This is like the whole cycle, but also in a week. Some traders experience a lot of disbelief, some hope, some optimism, some denial. Some people are about to suicide. Some people are angry. Some are feeling depression, disbelief, panic, emotions everywhere. But let's start firstly quickly with emotions. The easy definition I believe is the better definition is emotions are a complex psychological but also a psychological response to stimuli, and it can be triggered by an internal event or an external event. So internal, something that happens in your head by thought alone, you can create emotions, many of them. And external events. It could be, in real life, the conversations, the pleasant, the unpleasant conversations, the time you get liquidated, emotions everywhere. And what people, they don't know is once the emotion happens, it's not always, totally gone. Emotions can stack up, and they can interfere with the decision-making process. In essence, they are not really bad or good. Why? Emotions, they serve an important function in human psychology. It's believed they play a role in a few things, especially in social bonding or bonding, decision making, and survival. I mean, many of the decisions we make are actually based on emotions. So I don't per se think they're bad or good. There are a lot of negative and positive emotions. This is something different. However, I do believe we have not the full control of these emotions because they just happen. We cannot control something that, it's created by our brain. Our brain is 24/7 active. We cannot control them. We can have an impact on our behavior. Again, trading, investing is an execution thing. The more mechanical it is, of course, the less emotions. I'm not a mechanical trader. I'm not a non-discretionary trader. I'm a discretionary trader. I do things on my own discretion. So these emotions, they need to be managed on a regular basis. With that said, let's now deep dive a little bit deeper into selling. Very binary. There's buying and there's selling. Let's say buying is the 50%. And selling is the other 50%. Of course, there's a process before the actual buying. Think about reading the white paper, doing your own research, going to seminars, events, checking different Discord groups, Telegram, checking the smart contracts, and so forth and so on. So there is a process before that. And then there's the actual buying, which is basically one click on the button and bam, you bought something. In between, there's the waiting and the managing period, where I think a lot of biases kick in, and that's actually where people actually screw things up. And then there's the selling, and also after the selling, there's a process. It's a process of often the lot of thought processes after the selling, because people, they will think, oh, was it actually a really good time to sell? Maybe I should have capped, or maybe I should have done this and this. I'm gonna go later through my golden rules. Everything will make completely sense. So back to buying and selling. Selling is really hard, mentally, psychologically, more harder than buying. Because we have really good reasons for buying and less actually compelling reasons for selling. On top of that, once we have bought something, so let's say you use the T for, let's say, coin ABC, then we start to develop emotional attachments and we tend to create biases. And one of the nasty biases is post-purchase rationalization. So we try to rationalize our purchase, after we have bought it. So we tend to find reasons to justify our purchases. So one of the reasons could be, I bought coin ABC and they onboarded a new advisor, a new team, a new tokenomics, and so forth and so on. There's always a reason to justify your purchase. And it can also be with normal stuff in life. With your phone, I recently bought an Arco, and just now I'm reading the manual, and now I'm finding reasons to justify my purchase after I purchased it. So that's one bias. Another bias that always kicks in when it comes to that, withholds you from selling is confirmation bias, which leads us to only accept information that aligns with our original thesis. And then we have, of course, the herd bias that kicks in. So as you can see, different biases, they stack up. And don't think they happen consciously. No, they happen unconsciously. You are not aware that all these biases are kicking in. So what happens then is the brain is going to create different scenarios, especially when prices going up. We tend to increase our mental target points. Imagine you bought a link, for example, at $10. Your target was actually $45, and then it went right through the $45, and you think, okay, it's going up. Recency bias kicks in, and you're not able to sell because you created that mental picture that your coin is going to go even higher. So you're actually afraid of missing out on potential future gains. So as you can see, a lot of different biases, they kick in. You don't have this with the buying. You do have this with the selling. With the buying, you're often afraid that you're wrong with your thesis. With the selling, there are a lot of reasons to be afraid. And another thing I want to address, and this may be a little bit, it could be common, sense, common knowledge, but it's not common practice. And this is a big fallacy. A lot of traders, investors, it doesn't matter, they tend to let their losers run and they cut their winners. And this shouldn't be part of your selling strategy. It should really be the other way around. Because of loss aversion, people, they let their losers run. Why? In the hope that it will reverse. They're going to close their winners to lock in some profit because they don't want to give profit back. Of course, you don't want to give profit back to the market. That's okay. But a winner always needs to be run until it's run out, and then you can close the position. Just because it's a winner and then you want to close it, this is not a good strategy at all. Imagine you both link here in this green zone back in 2020-21, and your average entry, let's say, was $10 to make it easy. And it went all the way up to, I think it was $55. And now you are $100,000 in profit. Don't think that at that time, when it was trading at $55, that is a ideal point of exit. Once the price is going up, we also tend to increase our target point. So if it's trading $55, we are hoping for the $60. When it's going to the $60, we're hoping for the $65. So there is no, you don't know when it's enough. But as you can see here on this chart, let me go to the real chart here. If this is your all-time high in equity, and I'm going to go later through my golden rules when it comes to selling strategy and mental framework, you're really happy, of course, with this $100,000. And $100,000 may be for you a lot of money. It's also for me a lot of money. Still, subconsciously, we're hoping that it will go even higher. And then here it tanked pretty significant, all the way to $15, always causing you a heart attack. And then it increased. This gives you, of course, a lot of hope, but still you're 35% away from all-time high. So you're thinking, no way I gonna sell. It needs to go higher because now I lost basically $35,000. This is the wrong way of thinking. Never compare yourself with your all-time high P&L. The way of thinking is, I am still significantly up since my entry rather than I'm significantly down against my all-time high. This is, do you guys understand the way of thinking? I hope you guys understand my thinking, because if you anchor something, a specific price point or a P&L, it's going to interfere with your decision-making process. Again, your brain, your mind will always go for the path of least resistance. And when things are making consistently a lower high, for example, here you're 65% down, you're gonna feel stupid, and internally, mentally, you're still actually up, but mentally, you're down $65,000. That hurts a lot. And then it makes here a new lower high below your entry. You lost a lot of money. You lost 82,000, but also from your average entry, you lost a lot of money. And as you can see here, you feel pretty stupid for losing a lot of money. And then there's the time capitulation. And things, can go up again, but without you. This happened to many of us. This happened also to me back in 2018. I talk from first-hand experience, and this is exactly what I would love to avoid for myself, but also for you. But this can only happen if you have a strong mental framework when it comes to selling strategy. Doing things just on gut feeling, no way this is going to help you. 100%, it will not help 95% of all traders unless you're extremely experienced, you're equipped with the best tools possible, and you have experience, more than 50 years experience in trading and reading the market. And I'm pretty sure most of you, including myself, are not at that level. And even if you're at that level, you need to have a solid strategy. You cannot only rely on gut feeling and intuition. Intuition per se is not wrong. From a NLP perspective, I see intuition as could be seen as unconscious competence. So you have reached a competence level so high that everything happens subconsciously. Just like, for example, driving a car. You don't need to think about it. But when you started with driving a car, you were really conscious about everything. Okay, my foot needs to go there. I need to do this. I need to press this button, and so on and so forth. But once you have this subconscious competence or unconscious competence, it can help. After not trading, I just know like a few people who really can rely on their gut feeling and intuition. 90% not. You can better rely on a edge, on a technical edge, on a mental edge that has proven itself over time rather than gut feeling. This is a typical NLP communication model. I want to quickly go through it before I'm gonna go through the golden rules, my golden rules when it comes to selling strategy. We tap into this world through our five senses. And we don't see the world as how they are, we see the world as how we are. So based on our model of the world, we delete, we distort, and we generalize information, and this eventually will trigger a certain behavior. So your beliefs about yourself, but also about the market, they matter a lot. If you don't have a foundational belief about selling strategy, you don't have a strategy. It's simple as that. In 2 slides about to the golden principles, but this is principle number 1 actually. If you don't have a plan for profit taking in this bull cycle, you're setting yourself up for some serious face palming later. This is literally what I have shared in Discord, and I really believe in this premise. If you don't have a plan for profit taking, you're screwed up. Period. Even if you had a beautiful entry. Because you're going to set yourself up for some serious blame. You're going to blame yourself. You're going to blame others. You're going to blame KOLs. You're going to blame Discord. You're going to blame books. You're going to blame YouTubers. You're going to blame the Fed. You're going to blame your government. You're going to blame maybe even your neighbor, your wife, and but the only one that needs to be blamed is your strategy. Your strategy just sucks, or there wasn't actually a strategy. So have a selling strategy for this cycle, because 95% of all coins, they're gonna capitulate. Most likely Ethereum and Bitcoin not. I'm still not really convinced to sell all my Bitcoins at the end of the cycle. Probably I will, but for the rest, no way I'm gonna hold all of them. Maybe a few of them or a little bit, but most likely the majority I will sell. Again, most of the decisions we make are based on emotions. Don't let these emotions cloud your judgment. Rather, try to rely on principles. My principle is selling the top is for losers. Perfection is for losers. I'm not aiming for perfection at all. I don't believe in perfection. Not in trading, not in relationships, not in food. I just don't believe in many of the things. There is no room for perfection, especially when it comes to trading and selling. There are a lot of cloud chasers on crypto Twitter claiming that the top is in, and they repeat themselves every week or even sometimes every day. And of course, a broken clock is always right once in the well. So if you're gonna claim the top is in for 1 year long, of course, on one time you're gonna have the top, and then they will use that specific tweet to claim that they have predicted the top. It doesn't work like that. You don't want to predict the bottom. You don't want to predict the top, because once the top is in, you already gave up some of your profits. That's my premise. I'm gonna go to the on this sheet, the second one. The all-time high P&L is just a number. It's just one single data point, and yet it's the most obsessed thing. We are the most obsessed with this data point, our all-time P&L. Trust me, it's just a number. Don't ever let that all-time high in your P&L enter your mind and causing you anchoring bias. This is an example, just like a basic example, $100,000. You have your P&L, it's $100,000. This is the highest P&L you have ever made. And you don't want to go lower than that. So your next aim, your next target is going above that 100,000. This is the wrong way of thinking. It's just a data point. And the third principle on this sheet, on this slide, is selling 20 up to 40% below your all-time high is fine. It's really fine, because if you want to ride a whole cycle, a whole trend, you cannot predict the exact top, because once you have seen confirmed reversal signs, and next time I'm going to deep dive into what I'm using, you already gave up some of your unrealized P&L. It's simple as that. Selling anything between 20 up to 40% below your all-time high is just really fine, as long as you are still above your average entry. It's a really broad range, 20 up to 40. This really depends on your system, your risk tolerance, experience, how you have been diversified, and so forth and so on. But really, selling between 20-40% below your all-time high is fine, and don't let your all-time high function as an anchor, because once anchoring bias kicks in, it's really difficult to get rid of it. Principle number 4 on this slide is know when it's enough. If you don't know when it's enough, if you do not know when it's enough, it's never enough. You will you will not be able to close your position. At some point, you need to understand for yourself, this is good enough profit for me, and this is something that will change my life, and then you should be okay with it. I'm not saying you should close everything, but it doesn't really matter if you're going to close a big portion of it and upgrade basically your life. Know when it's enough, and ask yourself, do you know when it's enough for you? Do you know when it's enough for you? If the question is no, you have a mindset problem here that will interfere with your execution, period. You need to know when it's enough for you. Another one is, whenever things are in price discovery or we are in a confirmed strong bull trend, ask yourself who is in profit and who will sustain this bull trend. For the same matter, we could have here Bitcoin also on the chart. This is a line chart, but nonetheless, things are going up. When things are going up and it's in price discovery, ask yourself, okay, who's going to sustain this, this entire trend? Where will the new buyers coming from? See it like this. As price goes up, buyers are getting absorbed. Very one-on-one basic TA also. Here, this is another example. This is a typical resistance zone, as you can see here. This box here. So here, sellers exhausted, absorbed here. Sellers were absorbed here. Sellers were absorbed here. Sellers were absorbed here. Sellers are absorbed here. This is simple TA. Okay. Another simple way of thinking is, when things are going up, ask yourself, okay, this trend has been sustained by buyers or a lack of sellers. Now, who's going to sustain this trend? And then ask yourself, at which point will all the buyers have been absorbed? You can do this on the Bitcoin chart, especially the high caps, and ask yourself, where will new money come from to sustain this trend? Nothing will go up forever in one straight line. And eventually, every bull market will be followed by a bear market. Period. That should have been one of the principles here as well. Every bull market will be followed by a bear market. My last principle here, and if you're smart, make a screenshot. If you're smart, write this down. If you're smart, tweet about this. Really, just listening to me is not going to help you a lot. You need to execute. You need to take action. My principle is, a plan without a selling strategy is not a solid strategy. Because a plan without a selling strategy is a plan that's not complete. You're missing at least 50% of your plan. There are people with a selling strategy. You're competing against them. They have a plan. You don't. It means you have a handicap. You need to have a selling strategy. Otherwise, your strategy is not enough. Even if you have a beautiful, once-in-a-lifetime entry, you need to have a solid selling strategy. Otherwise, you don't have a strategy at all. This is a quote from, I think, Ned Davis, if I'm not mistaken. And he once said in one of his books, there are two types of investors, be they large or small. Those who don't know where the market is headed, and those who don't know that they don't know. I love to put myself in the category of those who don't know where the market is headed. There are a lot of people who don't know that they don't know, which is causing them to not rationally thinking, but just follow their gut feelings. Again, there are a lot of different biases. I think this is something for the next time. One thing I would love to share here with you guys. We have learned a lot from 2013, from 2017, 18, from 2020, 2021. Bull markets come and go. A bull market come and it will be replaced with a bear market, period. If you lost a lot of capital, or you were not able to realize your profit back in 2021 or 2017, it's really time to divorce yourself from bad old habits, especially in this market condition where a lot of ETFs are purchasing Bitcoin as if there's no tomorrow, almost 1 million. There's a lot of institutional adoption. This is once in a lifetime opportunity, I believe. It's really time to divorce yourself from bad habits. There are a lot of bad habits. I have them, you have them. Make your strategy complete by having a selling strategy. Knowing when to scale out, know when it's enough. Go please through these different principles. This is principle number 1. If you don't have a plan for profit taking in this bull cycle, you're setting yourself up for some serious problems, serious face palming, serious regret, serious anxiety, serious depression. Understand these principles. They will function as a foundation. Next time, we're going to deep dive into the different technical strategies we can apply for our selling strategy. Different selling techniques, I should say, different techniques to skill out. And again, these pillars, these points will, this is your foundation. This is your truth. This is the principles we should follow. I'm gonna repeat quickly. Selling the top is for losers. Perfection is for losers. The all-time high is just a number. If you're obsessed with your P&L, you anchored this in your mind, and confirmation bias will kick in. Recency bias will kick in as well. You're going to set yourself up for a major failure. Selling below your all-time high is really fine. No problems with that. Know when it's enough, and understand when things are in a strong bull trend. Understand who is in profit and who will sustain this profit. Last but not least, a plan without selling strategy is not a solid strategy. This is our framework. Until the next time, I'm going to go deep dive into the different tools. I use Fibonacci, MAs, RSI, and a few others. I will explain how I'm using them, how I utilize them. And in the next video, we're going to do a stop loss workshop, how I place my stop losses. And that's it for today. Thank you so much for watching. Until the next time, God bless. And if you have any questions, you know where to find me on Discord. Peace out.